thanks to, I think, my co-conspirators, Phoebe and Amanda, for putting this series together. Amanda for all the most of the content, and Phoebe for all the administration. So I do the thanks at the start, otherwise I forget at the end. We've got something a little bit different today with Caleb and Bradley going to be joining us and doing the bulk of this presentation. So what I will do is I'll hand over to you, Amanda, and you can introduce Caleb and Bradley. But I've seen some of this presentation in a different form, so I'm pretty excited to hear it again because I know the level that it's done at, and I find it really interesting. So yeah, thank you very much, Amanda. I'll hand over to you and put myself on mute for the next hour so I can listen. Thank you.
Awesome. Thanks, Mark. So welcome back, everybody. I am here in a support role today. So I'd like to introduce Caleb and Bradley. They both work out of our Stratford office. They're both farm boys, and they both work predominantly with agri clients. So over to you guys.
Hi, yes, as Amanda said, I'm Bradley, working at the Stratford office. Mum and Dad, we're sharemakers growing up, so managed to get plenty of time on the dairy farm, and predominantly do rural accounts, although I do have quite a mix of clients and come from both a commercial and accounting background.
So hi everybody, I'm Caleb Kahupukoro. So just a little bit about me. I'm originally from South Taranaki, and I specialise in commercial and farm accounting as well as tax compliance. So just about today, I'm really looking forward to presenting this webinar to you guys, and I really hope that you can take a couple of things away from the session that will help you in your farming business.
Cool. Now, just going over the agenda for what we will touch on this morning, I'm just going to go over a few of the tax basics. We have a brief discussion over what is deemed as taxable income for farmers, as well as what can be claimed as a deductible expense. Brief talk about income tax before moving on to some of the basic business structures that are available to you in business, and a couple of considerations to think of when deciding which structure is best suited for you. Then move on to discuss a little bit about the GST employment around the tax and filing obligations around both of those, before finishing off with a few tips around record keeping and coding, and a little brief talk about software to kind of complement what Amanda's already discussed on during this series. Just like to, and then as Mark said, we're going to have some time for questions at the end of it. Moving on to the next slide, please, Mark. Yep, and we can probably go to the next one after that. Now, in the first webinar, Amanda talked about the profit and loss statement. Two main sections, as I mentioned before, of the profit and loss is income and expenses. Firstly, we've got income. We've got the obvious items such as your milk check and sales from stock, wool, crops, all the way through to dividends and interest income on any investments that you may have. There's also some not so obvious items. Firstly, we've got depreciation recovered. Depreciation recovered occurs when you sell an asset for more than book value, but less than the cost you paid for it. Now, those of you which may not be 100% sure or heard of it before, a book value is the asset's cost price less all depreciation which has been claimed against it. Secondly, you've got non-cash rental income on employees' dwellings. Now, in farming, it's common for employees to have accommodation included in their employment package. The value of the accommodation is taxable and included in the employer's gross wages and taxed accordingly. And for employers, this value of this accommodation is shown as rental income in your accounts. And lastly, we've got livestock revaluations. Amanda covered the two main methods of valuing livestock in the first webinar. You've got the NSC and the herd scheme. Just wanted to reiterate what she touched on back in that webinar. Any increase in the value of stock on NSC and any increase in value of stock being moved from NSC to herd scheme for the first time will create income. Moving on to expenses, we move to the next slide. For an expense to be deductible, it needs to be linked to an income-making activity. Now, for farmers, your day-to-day running costs of the farms are all deductible, including if you run farm dogs on the farmer's part of your operation, you can claim the costs linked to running those, such as their food, vet bills, registrations, etc. Nothing's personal can be claimed as a business expense, however. These include things like your groceries, washing powder, cat food, and your day-to-day clothes. However, if we move to the next slide, there are some expenses which have both a business and personal portion to them, and we need to split the personal portion out accordingly. You are allowed to make a 20% claim on your house power, 50% of your phone and internet bill, and 25% of your vehicle expenses for any vehicle which is used for both business and also personal, unless you complete a logbook. But what a logbook is it's a record of all your trips for the vehicle over a 3-month period. You need to record the distance of each trip and whether or not that trip was business or personal. At the end of the 3 months, you calculate the percentage of the trips which were business related, and that percentage is what you can claim your vehicle expenses going forward for that vehicle over the next 3 years while the logbook is valid for. And we will also need to split out any private portion on insurance premiums as well. You can claim 100% of the insurances which relate directly to the farm operations. These are on things like your plant and machinery, your livestock, business liability, etc. You can also claim 20% of the house insurance for the house that you live in, if you're owning a farm owner. And also allowed to claim 100% of the insurance on any employee dwellings. Now, for tax purposes, we treat the employee dwellings the same as we would a rental property. Mixed use insurance for the mixed use motor vehicles, is exactly the same as I talked about before. You can either claim 25% or whatever rate is set by the logbook. And lastly, no claim is allowed for any contents insurance. Now, if you ever find yourself tempted to push the boundaries around what you do and don't want to claim, you need to take a moment and ask yourself on whether or not you could successfully argue your case to the IRD if they ever came knocking. You need to weigh up the cost v reward of those questionable claims, because IRD audits are a very real thing, and I've seen them cost clients thousands and thousands of dollars. They are really expensive to get hit. Moving on to the income tax section now, I thought it'd be a good thing, just a brief discussion. Some of you people here today watching this upcoming season might be the first time that you're in self-employment. Just in case that it is, the biggest difference between being paid wages and being self-employed is the timing that your tax is paid. But when you're being paid wages, your tax is automatically deducted when you're paid, and your employer files a PAYE return each payday to record your income with the IRD. However, when you're self-employed, you need to have annual sets of financial accounts prepared and file tax returns for the IRD to return your income, and you yourself are personally responsible for paying your income tax to the IRD. Now, for the first year of self-employment, if you just want to click through a couple more times, just get through to the second row of the table. Yep, leave it there, thanks. That's good. It's incredibly important to put money aside for tax in your first year of self-employment, as the bulk of your tax will be payable in the second year. Probably easier to show an example of this. Now, this is based on a farmer operating as a sole trader with a May balance date. To keep it nice and simple, I've used income of $70,000 across the first 3 years. In the first year of business, as you see in that top line, no tax was payable. Income was earned of $70,000 with tax payable on $14,020 due on the 7th of April. You'll see that in the second line. In addition to this, they have also qualified as provisional taxpayers and will be liable for 3 equal instalments of $4,907 due each on the 28th of October, 28th of February, and 28th of the following June. So what this means is that this farmer will have almost $24,000 of tax due between the 1st of June and the 31st of May in the second year of business, with an additional almost $5,000 of tax due a month later in that June. Now, if they had put money aside in that first year for the tax, paying that $14,000 on the 7th of April shouldn't be an issue. However, if they don't, they can put themselves under pressure and really stress out both themselves and their cash flow over that time. Now, I had a mate of mine go into business probably 6-7 years ago, and they went into business and had a really good first year. Unfortunately, they weren't given a heads up regarding tax obligations and how it all worked. So it wasn't until they had the year-end accounts prepared and received their tax bill did they realise what they were in for. A heck of a shock. They got, really quite tight, and it was quite a stressful time for them. Thankfully, they did get through it. But I think it's just an example of just how easy it is to be caught out if you're just not aware of what all your obligations are and what they involve. Now, just going back to my example, second year of business has just finished, earned another $70,000 of income, and again is tax payable of $14,020. They will again qualify for as provisional taxpayers, with tax during October, February, and the following June. However, unlike last year, they've actually paid provisional tax of $14,721. So rather than having a lump sum to pay on the 7th of April in that third year, they're actually due a refund of $701. Now, this is the benefit of the provisional tax system. As long as you stay within the provisional tax net, you'll be fine. The only time you might be in line for a larger tax bill in April is if you get a spike in income one year. Just move on to the next slide. Now, I just thought I'd finish off the income tax discussion with just talking about a couple of the tax planning tools. Well, I'm aware Amanda touched on in more detail income equalisation and milk futures in previous webinars. And if you haven't caught up with those webinars yet, they are really useful to watch, and yeah, you learn a lot from them. I need to briefly touch on these. These are all quite in-depth topics, and you could probably quite easily spend a couple of hours on each of them. Obviously, we don't have time today. Just wanted to bring them up so you knew that they're there in case you did miss the earlier webinars, and if there's any of them which spark your interest or you want to know a bit more about, touch base with the accountant. They can discuss them in more detail, pros and cons, and you can decide whether or not it's something which will benefit your business. Now, firstly, we have got tax pooling. Now, we will often use tax pooling if you have late or underpaid your tax during the year. Tax pooling agents charge a lower interest rate than the IRD do if you pay the late paid tax straight through the tax pooling company. You can also avoid the IRD's late payment penalties by using the tax pooling agent. Secondly, we've got income equalisation. Now, this is a tool which we can use to spread your income into future years if needed. There is a cap of maximum of 5 years that you can carry it forward to, and there's a few rules around that, but it is quite a useful tool to have available. And lastly, we've got milk futures. There's a few different types of milk futures in the market today. Basically, milk futures are a way of fixing your milk price on a set percentage of your milk supply for the season. Now, the benefits of doing this is very similar to the same reasons you'd fix your interest rate on your mortgage, and that it can provide some certainty over your cash flow and your planning. Now, in our next section, we'll move into business structures, and we'll just discuss some of the common business structures that are available out there. Firstly, with sole traders and partnerships. Sole traders are people which are in business in their own. It's all in their own name, while partnerships can include 2 or more people. It's common for farmers, for couples, say husband and wife, to operate as a partnership. Under both structures, the owners control and manage the business on their own. Now, I think it'll be a good time just to have a quick pause here, and just before we talk about how the income is distributed, of just going over the income tax rates and the way that it works in New Zealand. In New Zealand, the income tax rates are based on a TED system. So the way this works is income earned between the first $14,000 of income is taxed at 10.5%. Income earned between $14,000 and $48,000 is taxed at 17.5%. Income earned between $48,000 and $70,000 is taxed at 30%. And any income over $70,000 is taxed at 33%. Now, with sole traders, as mentioned before, they are in business in their own name, so as such receive all of the income, and it's taxed at their individual tax rates. Partnerships are slightly different, however. Partnerships themselves do not actually pay income tax, and any income or losses are distributed to each of the partners based on their share of the partnership. The partner's share of income is then taxed based on the individual tax rates discussed earlier. Some of the benefits of sole traders and partnerships are they're easy and simple. They have low compliance costs and can be a really good structure when starting out farming. However, one of the downsides of operating as a sole trader or in partnerships is that because you're in business in your own name, you're personally liable for the debts of the business. And as a result, any of your personal assets may also be at risk. even if they are completely separate from the business. The partnerships also offer an additional level of liability for all partners, as they're all jointly and severally liable for the debts of the partnership. This means that they are not only liable for their share of the debt, but for the entire debt of the partnership if something was to happen to the other partner or partners. Example of this would be, say, Sam and Ben were in partnership together, each owning a 50% share. Partnership is $100,000 worth of debt when Ben flees the country and can't be contacted. The debt has to be paid, so Sam needs to ensure that the debt is paid in order to avoid the consequences of defaulting the debt. If Sam can't get hold of Ben to convince him to pay his share of the debt, Sam is personally responsible for having to pay back the entire debt himself. With sole traders and partnerships, they also have further limitations around tax planning and succession planning. They are also limited to where they can source their capital from. Unlike companies who can issue more shares to bring in more capital, sole traders and partnerships are pretty much limited to using loans to access their funds. And while sole traders and partnerships can be a really good structure when starting out, it does pay to talk to your accountant and your lawyers just to talk about your options before you buy any substantial assets, such like a herd, for example, just to protect yourself from any unintended tax consequences down the line. I'll just pass you over to Caleb, who'll continue the discussion surrounding business structures.
Cool. So moving on to the next slide. So next structure is a trust. So in a trust structure, trustees are responsible for managing the trust assets for the benefit of the beneficiaries. Okay. In terms of tax is initially charged at a rate of 33% unless profits are distributed to beneficiaries in which their marginal tax rates will apply. Okay, so some of the pros for a trust is that you can distribute income to beneficiaries to make use of lower marginal tax rates. It's also easier to distribute capital gains than it is in companies. As companies, you can only distribute once a company is wound up. Also, trusts provide good asset protection. So there's no claim on trust assets by trustee or beneficiaries' personal creditors. And also it can be a good option for simple succession planning. So moving on to our cons now. So there are greater compliance costs than sole traders and partnerships, as there's an extra level of complexity. Okay, also to note that there's a new trust act being introduced in January 2021. So this will increase disclosure requirements for trustees to all beneficiaries. So just something to be aware of going forward if you're looking at this type of structure. Okay, in terms of limitations with succession planning, so ownership transfer is not as fluid as a company, as you can buy into the business via shares. Okay, so a trust would have to physically transfer each asset out of the structure, which would increase costs such as lawyers' fees and accounting fees. And then finally, costs to set up. So obviously with the additional complexity, there will be additional costs for formation of the trust and also the establishment of the trustee. So moving on again to a company. So a company is a separate legal entity from the people that own it, it's shareholders. In terms of tax, it's initially at a rate of 28%, but not when it's distributed. So there's two ways that income can be distributed from a company, either as a dividend, and when a dividend's paid, you'll be required to pay an additional 5% withholding tax, so shareholders can access the retained earnings in the business, or shareholder salary. So if a shareholder salary is issued, then the tax will be charged at the individual's marginal tax rates. So again, looking at some of the pros, so there are limited liability to shareholders. So you can only really lose what you've put into or invested into the company. There is an exception there where you've made a personal guarantee on loans that are held within the company, in which you'll be liable for the debts. In terms of succession planning options, so as mentioned under the trust section, companies can issue and sell shares, so shareholders can come and go without having the burden of transferring ownership of assets, because the assets are owned by the company, not the individuals. And also the costs are easy. It's easy and low cost to set up. Some of the cons include high compliance costs, so as well as complying with income tax laws, the companies are also governed by the Companies Act 1993, which adds another layer of complexity and compliance that you need to deal with. In terms of capital gains, so as mentioned in the trust section, these can only be distributed when a company is wound up. In addition to this, winding up a company can be a costly process. So it is something to think about if you're looking at the structure or down the line when you're looking to wind things up. And also, this finally, they're accessing cash. So shareholders can only draw down the funds they've contributed to the business. So any funds over this will be liable for interest on the overdrawn amount. Okay. So there are some instances where interest may not be charged, but this will give rise to a non-cash benefit where you'll be liable for fringe benefit tax. So either way, you're going to be paying tax either if interest is charged on, so under income tax, or you'll be caught under the fringe benefit tax net, which we'll cover off a little bit later in this in our slides. Cool. Finally, just a final structure, just a look through company. So I won't get into too much detail in regards to the structure. It's just something to be aware of, that it's an option if you're looking to, an option when looking to carry out your farming business. So under a LTC, it's a separate legal entity from its owners. However, for tax purposes, it's treated like a partnership. Okay, so I won't cover all the details. You can probably read off your screen some of the pros and cons. Just to wrap up this section though, I really want to probably reiterate that depending on where you are in the farming spectrum in terms of ownership, you may have a combination of these structures when running your business operation. So obviously situations and circumstances change, but it's good to have an idea of how you want to structure your business, as it can save you any unnecessary costs in the future. Cool, next slide please.
Hey Caleb, I just wonder if that's a nice little spot to just see if there's any questions come up around those all those structures and stuff.
Cool.
So I haven't got any come through yet, but if there are any questions around there, please chuck them in the chat and I will answer them if they come up.
Cool. In that case, we will carry on. Perfect.
Cool. So the next few sections, we're going to look at some of the other taxes that will impact your business in addition to income tax. So obviously GST. So what is GST? Well, it's simply put, it's a flat tax rate of 15% levied on the price of most goods and services. Okay. If registered, you'll be required to return GST on income and be able to make GST claims on your purchases. There are some exceptions, which we will cover off as we move through the slides. So starting off with returning GST on income, this would include things such as your milk check, stock sales, farm asset sales. So for example, if you were to sell a motorbike or a piece of machinery, there is an exception for farm sales if they're sold as a going concern, or land is a component of a transaction of a sale, in which they would be zero rated. Okay, so pretty much if something is zero rated, this means that there'll be no GST to return or claim for the vendor and purchaser respectively. Cool. In terms of claiming GST on expenses, so 100% of your farm expenses you'll be able to claim GST on. So that'll include things such as your dairy shed expenses, stock purchases, overheads such as farm shed electricity. Also, as Bradley provided earlier when he discussed the business portion of your farmhouse and vehicle expenses for income tax and how that's deductible, you'll be able to claim the GST portion related to those amounts also. Okay, farm assets, so we sort of covered that off in the last slide. Probably something that's not on there on the slides, but also mixed assets that are purchased, so where there is a business and private portion, so you'll be able to claim the GST on the business related portion of the asset, and the same notion applies when you're selling that asset also. Cool, next slide. So in terms of where no GST claims are allowed, so private expenditure, so again, there must be a relationship between private expenditure and carrying out your business operation. Okay. Residential dwellings, as well as things such as interest on bank loans, principal repayments on loans, bank fees, wages. These are all exempt suppliers and not subject to GST. I probably just want to point out that just around exempt supply, sometimes these can be significant outflows to your farming business. But yeah, I really want to reiterate that you shouldn't be using inflows versus outflows as a proxy for how much GST you might have to pay from month to month. I know that I've had a client assume that they've had no GST to pay because their outflows were greater than their inflows, and that's just not the case. It's probably something that's simple, you know, like you'd think, oh, well, I get that, but yeah, sometimes that's not the case, and I just really want to reiterate that point there. In terms of other GST considerations, so in regards to tax invoices, I already require that a tax invoice is obtained on any supply of goods and services over $50. Despite this, it's still good practice, and I would strongly recommend retaining all invoices and receipts for purchases related to your farming operation. And then finally, there just around second-hand goods. So there are special.
Caleb, just before we move on to second-hand goods, just had a couple of questions here. Surely the worker's house is an essential part. Philip asked, surely the worker's house is an essential part of the business for GST?
Nah, so anything that whereas it's a common place of abode or like a resident or a dwelling in which you live is not captured under the GST net. Yeah, that's how the law is written.
Okay.
Just be clear there, Caleb. It's a deductible expense. It definitely affects your tax, but it's not GST because it's residential.
Yes, that's correct.
Okay, and the second question is, why are wages not included in GST claims?
So again, they're an exempt supply, and their tax is captured on that via PAYE. I don't know if anyone else in the team wants to elaborate on that anymore.
So just wages is, I am off mute, that's good. Wages, they're not a deductible expense. It kind of comes back to how it's treated. So with most GST transactions, there's an in and an out and they balance. So there's two sides to the story. So for instance, when you receive the milk check, that's income to you and it's an expense to the manufacturer, right? So they're claiming the GST on what they've paid you and you're returning the GST. With wages, people who you're paying wages to are self-employed, so there's no other side to that story. If they were contractors, that would be a different story. So we're not paying GST on wages. We're not paying our staff their our hours plus GST. Therefore, we don't get to claim the GST on that.
Cool, thanks, Amanda. Hopefully that answers that question.
I've got one other question here too, Caleb and Bradley, if you want to jump in here. Philip asks, would there be an instance where you would actually recommend clients to change structure or change the type of their entity?
Probably when it comes time to buying a herd, we'll often set up, especially for new farmers, that we'll set them up for kind of sole trader or partnerships depending on who if they're working with somebody else. Initially, in that, just while they get into the and get set up in the industry, and also to see whether or not they are going to hang around in the industry. When they sort of commit for a longer term, say buy into a herd, getting ready for 50-50, we'll often talk to the clients about whether or not it suits them to move into something like a trust or a company, just in the sense of so that way that the assets they're buying for the long-term hold in the industry is in the kind of structure they will carry forward on. We're just mindful of they don't want to kind of bounce too much back and forth because there are quite a few rules about related party transfers, which are quite technical. There's quite a bit to do with them, so it's to try and avoid any of those catches.
Agree with that.
Yeah, I do agree with that. Again, it is really expensive. Like I know for me personally, we've just set up a family trust for us, and that's just a simple trust, and that's costing us a couple thousand. And then when you start doing multiple changes in that, you've got all your lawyers' bills, you've got all your accountancy bills, you've got everything else in that. So there will be times which you will need to change stuff, but you do want to try to limit how many changes you need to do unnecessarily.
Yep, and I'll just reiterate there, I definitely went over it in the first 2 webinars, but that's where it's really important to keep the conversations going with your advisors so that we actually know what your goals and aspirations are, because it's really hard for us to make a recommendation, like Bradley was just talking about, if we actually don't know what your future plans are, because we don't want to give you advice now and then find out that if we'd known one other little trivial piece of what you might think is a trivial piece of information, but if we'd actually known that, it may have changed the recommendations that we might have made.
Awesome, thank you all. I think I interrupted you with one more point to go on the slide, Caleb, sorry.
Yep, no worries. So hopefully those provided answers to those questions that have just come up. So just finishing off the slide, so just around second-hand goods. So there are special rules that apply when they're purchased from a non-registered person. Okay, so although there's no GST charged on the goods supplied, you will be able to claim a second-hand goods credit so long as the supply is used within your business operation. Cool. So just moving on to some of the administration type of things, or administration type of things to cover with GST. So in regards to registration requirements, so you'll be required to register when your turnover is greater than $60,000 for a 12-month period, which I would expect most dairy farming operations to be. So you should be registered if you're not already. And also you can voluntarily register if you're below the threshold. In terms of GST filing options, so there's 3 options: monthly, 2 monthly, which we recommend for GST clients, as it allows you to keep on top of your paperwork, as well as not be stung by a significant GST bill, where you might be if you're on a 6 monthly basis. And then just finally around return filing and payments. So you'll be required to file your GST return and make payment on the 20th of the following month the GST period ended. The exception to this being in periods ending March and November, in which the due date will be the 7th of May and the 15th of January, respectively. Cool, next slide please, Mark. So just looking at employment now, so around PAYE. So PAYE stands for pay as you earn, and it's a type of withholding tax on employees' gross salaries and wages. So as an employer, you will be responsible for deducting and paying PAYE on behalf of your employees. So what should be taxed? So any base salary or wage for services provided, one-off payments such as bonus salaries, benefit allowances that are of a private or capital nature, and reimbursement allowances of a private or capital nature, and some benefit allowances. Next slide, please. Cool, so I've just got a table here that outlines some of the categories in which allowances will apply. So where they are agreed upon, allowances can be broken into 2 types, either reimbursing or a benefit allowance. Okay, so reimbursing allowances are paid by the employer for expenditure incurred or is likely to incur in relation to the employment and will be exempt from PAYE. As mentioned in the earlier slide, unless they are of a private or capital nature. So for example, if an employer paid a weekly allowance to reimburse the cost to the employer for purchasing wet weather gear, this would be deemed to be a reimbursing allowance. Flip side to that, a benefit allowance, on the other hand, is provided as a condition of employment and is liable for PAYE. So an example there might be where an employer pays an allowance to an employee for their child's bus fees. Okay. So just generally, where allowances are a regular feature of the job, it is a good idea to have them clearly specified, either in the employment agreement or in a workplace policy, so that it's clear for everyone about how and when they apply. So other deductions, so in addition to PAYE, where applicable, you may be required to make other deductions on your employee's behalf. So some of these will include KiwiSaver employee contributions, where your staff member has opted into a scheme, student loan repayments and child support. Also, where KiwiSaver is concerned, you must at a minimum contribute 3% of your employee's gross pay as an employer contribution. In terms of filing requirements, information must be submitted to IRD within 2 working days of an employee's payday, and as well as that, payment is required to ID on the 20th of the following month, and this is the sum of all paid out information that's submitted for a given month. Awesome. Now moving on to fringe benefit tax, or FBT. So this is a tax payable on the non-cash benefits provided to an employee in connection to their employment. So effectively, FBT replaces the PAYE that would have been deducted if an employee was given the money to purchase the non-cash benefit. So examples include motor vehicles where they're made available for private use. There are exceptions around work-related vehicles. However, there are certain criteria that must be met in order to apply. Also, low-interest loans provided to an employee by an employer. And I've got the provision of food there. So no. So if just to answer Mark's question, so no, FBT is not at the same rate as PAYE. So there's two rates that you can use, either an alternative rate, or a flat rate, and these are generally around about the 49% mark, depending on which one you use. Hope that answers your question, Mark.
Yep, thank you.
Cool.
So in some cases, or follow up, I guess, in some cases, is it sometimes easier to give actually increase actual pay rather than having to go through FBT because the cost of the tax will be much lower? Yeah,
it is. There's, in regards to FBT, the FBT regime, it can be quite complex, and there's a lot of judgment that's involved in determining whether if there is a benefit, and how you slice and dice it. So for simplicity, we usually recommend that any benefit would be paid as in cash and be captured under the PAYE regime as opposed to FBT. That's not always the case, but where you can, I would recommend that you do that. I don't know if any of the other team have anything to add there.
No, I agree with you there, Caleb. Just it is like Caleb said, it is a complex area, and there are some allowances and levels that you can sort of remain under to kind of just sit under the need for filing FBT returns, which I think you highlighted in the previous screen, Caleb, that there was some.
Yeah. So if they're under $300 for a quarter or $1,200 for the year, they'd be under the de minimis rules, so you wouldn't have to claim or will apply FBT rules in those situations.
So that one's particularly pertinent for the meat that you might provide on farm. So as long as the beast for the freezer remained under that level, it can just be treated as a perk.
Yeah, correct.
Cool. We just had one other question from earlier as well, and maybe aimed at both you and Bradley, Caleb, saying it sounds quite expensive to change the structure, is it?
I think we Bradley cover that? Yeah.
You did cover that one. Okay. Yeah. Sorry.
That's okay. Cool. So moving on, so just some other considerations around employment. So contracts. So it's probably aimed in particular with share milkers, contract milkers and farm owners. And it's just around understanding what you're responsible for and under what circumstances. So for example, who will pay feed requirements if there's a drought? Will it be split? Will that fall on the farm owner? Or for another example might be minimum fertilizer requirements. The farm owners is to supply for a given season. So all those sorts of things, clarity of expectations between parties will allow for a smoother working relationship. Salaried employees, so where salaried employees work additional hours that can impact their minimum wage requirements. So as an employer, it's up to you to manage this accordingly, either by monitoring hours or topping up income where appropriate. This is, I guess, especially important to monitor around springtime when generally with calving hours go up. Cool. In terms of records, so You are legally required to keep employment records. So this would include things such as your wage and time records, holiday and sick leave balances, as well as employee details and agreements. This can be an arduous task depending on the size of your operation and how many staff that you have. But there are some great payroll systems on the market that provide end-to-end support with all this. So I do recommend that you reach out if there's something that you'd be looking to streamline in your business. In terms of employment agreements, so very similar to contracts. So having that clarity of expectations from the get-go will help with that working relationship between employer and employee. In terms of health and safety, so just understanding what your obligations are. So by law, you must take all practical steps to provide and keep a safe work environment. So understand how to do that and what's required of you. And then finally, just around employee and contractor. So understand what the difference is between the two. So generally, if you control what the person does and where the work is done, then that person will be an employee, and an employment law requirements will need to be adhered to. Outside of that, if you engage a contractor to supply services, you will be required, or you may be required to withhold tax unless they can supply an exemption certificate.
Caleb, obviously one of the most common employee sort of structures in dairy industry is the contract milker.
Yep.
And it sounds from your description like they should be an employee, and yet we call them a contractor, and I think they pay their own tax and things like that. Do you want to elaborate on why we can do that?
So if you so as a contract, so probably I need to be clear about the contractor sort of thing. So where there's a contract for services, so where you're providing your services to someone else, you would generally have, the employer would generally have to make a scheduler payment. So that scheduler payment requires that a level of tax is deducted from that. Whereas if you're a contract milker, you are supplying assets and the like, as well as your time. Yeah, and you'll be registered, so you'll be invoicing for your services. Under that aspect, you'll be returning your own tax.
Okay, so the fact that you bring your own motorbike, etc., that's what kind of makes you a contract milker rather than a manager.
There's
Yes,
still
correct.
sorry, Caleb. There's still a different expectations around that as well. So, for instance, if you employ a fencing contractor on your farm, they may have their own equipment, their own bike and stuff to run the fence line. You might supply the materials, or they might buy them all and then invoice you. But either way, and if that contractor is a sole trader, they would still need to provide an exemption certificate, as Caleb mentioned earlier, to sort of mean that you don't need to deduct withholding tax from the payments that you make to them. Whereas contract milking, it kind of falls outside of that regime. But you have to be really careful if you're the owner and you've employed a contract milker. That doesn't mean, and this is where Caleb, I'm trying to be eloquent with my explanation, sorry. Caleb mentioned that if you actually make all the decisions on farm and the person that you've employed does what you say, then they're actually an employee. So if you employ a contract milker, to be a real contract, you don't actually get to tell them how to do the day-to-day ins and out running of the farm. You can certainly have conversations around the vision that you see for your property and all of that sort of thing, but you've got to be very careful around that, whether you're breaching that contractor versus an employee relationship.
Okay, that's a cool explanation. Thank you.
Cool, thanks, Amanda. Bradley.
Yeah, thanks for that, Caleb. I just thought with year-end fast approach, it'd be quite a good time just to go over a few simple tips which might be able to save you some money regarding your accountancy bills. Firstly, with record keeping, keep your records tidy and organised. File your records in a logical and consistent order, and make sure everything's there. But the three of these, they are all quite simplistic and might come across as quite basic tips in that, but I can't understate just how important it is on our end and the difference it makes if you do these. The easier you can make it for us to find what we need in your records and that to do your accounts, it's much easier, much quicker for us to process them. And lastly, just with the checklist, with our clients, we will often send out or we do send out to our clients an annual checklist, and this is just a brief summary and a list of the different bits and pieces that we'll need or may need to prepare their accounts. And this allows them to go through the list in their own time, just make sure that they can make their records as complete as possible. I'm not sure what other accountants out there provide, whether they do something similar in that. But if they don't, or if you haven't seen one and you are interested in something like that, have a talk with the accountant and see what they do have available and what they can provide you, just to make that task a little bit easier on your end. And just moving on to the next section with coding, just a few quick tips here. Aim to keep your coding as consistent as possible. Add narrations where required. Narrations are a really good way of bringing our attention as accountants to something, and it also explaining sort of how and why you've treated a certain item the way that you have. Before filing your GST, it's a really good time to take a moment and just review your coding for the period and just check that everything is consistent and that nothing looks odd or out of place. If something's looking a bit off or something's a little bit kind of out of the ordinary in that, definitely have a look at it, because chances are if it looks a little bit off, it potentially is. Fourth point there is avoid using the general expenses code if you can. In most cases, there are going to be plenty of other codes which are more appropriate and more accurately reflects what the payment relates to. And lastly, if you're in doubt, ask your accountant what code you should use or how you should code something. It's much quicker on our end to answer a 5-10 minute question, a coding question regarding that, than it is for us to find and then fix an error if you end up having done something wrong. Moving to the next slide for the next section, we'll just finish off with a quick.
Can I just jump in there, Bradley, too? Sorry. Just to elaborate on Bradley's point about being consistent. Even if it's wrong, it's easier for us to fix if it's wrong the whole way through in the same way. It's harder for us to fix and identify if you do it one way one time and another the next. So that consistency is a really key message there.
Yep, no, exactly right. Yes, so for those which may have missed Amanda's earlier webinars, and that she had some really good discussion across both of them regarding software, the different products out there, and the different ways they can help and what they can provide for your business and can help you out. If you haven't seen those webinars already, I do recommend going back and watching them. There's some really useful information, some good tips in them. But for those which may have missed the webinars, the popular software products which are available for farmers include BankLink and MYOB Essentials, Xero and Figured, and Cash Manager Rural. Now, these programs have a range of options to help with your record keeping. The introduction of cloud-based filing systems such as Xero's HubDoc and MYOB's Document Manager have been real game changers. We as accountants can be given access to your files via the cloud, and we can actually do your entire accounts without having any hard copies of your records. Now, if any of these do actually interest you, or you want to find a bit more information, talk to your accountants. They can go through the pros and cons of each product and help you decide whether or not it's something which your business would benefit with using. And lastly, I just thought I'd wrap up the presentation today, just touching on a few things to consider when the time comes to choosing what software program you choose. And I know Amanda has covered this, I think, in the last webinar on that. It's just some really good points just to keep fresh in your mind. Firstly, the software program needs to meet your needs, not only for today, but also for the future. You need to, when the time comes, sit down if you haven't already. What are your goals and where do you see yourself going? If you've got goals of progressing through the industry, then you're going to want to look at a software product which can continue to evolve and change and continue to meet your needs as your own personal needs evolve. And we're saying that there is a ton of software products out there. They can do some absolutely amazing things, but they all do come with a cost. So you are going to want to look at the cost benefit of each of the products and decide whether or not benefit you get out of using those products, of whether or not you can justify that cost. Is it worth it, or would it be better to spend that cash somewhere else? It is also important to look at the training on how to use the software program as an investment rather than just a cost. Take the time to learn the system, build your knowledge so that you can earn the efficiencies down the line. Not only will this end up saving you time with your coding, but it will also result in a tidier file. And on top of that, you're paying good money for some of these software programs, and that they can do some amazing things. So the more knowledge you have around how to use them, the more benefits you can actually get out of the full capabilities of those programs. And lastly, and I know this has been a bit of a common theme today, but as accountants, we're here to help you. Whether it be a phone call, an email, and that, we're always here to answer your questions to make your job as easy as possible wherever we can help. So feel free, if you've got something you need to ask throughout the day to day and that, give us a bell. We're always here to help. With that, just wanted to conclude some of the stuff we've covered on today, just to wrap the session up. We went over and discussed kind of what some of the items are which are deemed as income. We talked about what is and isn't deductible expenses and how to be deductible they need to be linked with income producing activities. Talked about the cost benefit of trying to claim the questionable deductions, the risk of ID audits. Went over the basic business structures which are out there, as well as the importance of considering your future goals when making the decision about what business structures are best suited for you. We went over the tax and filing obligations and what was involved with the PAYE and FBT under the employment sections, before finishing off with some quick tips regarding record keeping and coding and the importance of keeping things tidy and organised, as well as, and then finished off with just a brief discussion again on the software about and the needs, considering your needs and the cost benefits of those programs when making a decision about what best suits your needs. And that is our presentation. Are there any questions?
There's nothing further popped up at the moment, Bradley. So I'll just thanks guys for doing that. There was some awesome content there, and that Bradley talked earlier about the your record keeping and making sure it's complete. Another aspect of that, which I touched on in one, I can't remember which one, was just your livestock. Okay, so actually have a crack at doing a stock rec for yourself. So start with your opening stock from your last year's financial statements and try and figure out what births, deaths and sales you've had and come up with your closing numbers and see if they actually match what you're about to tell us you've got on hand at the end of the year. Because we actually quite frequently invest a lot of time trying to figure that out, and that can be quite time consuming. And for us, time is money. So, you know, the less time we have to spend on that sort of thing, the better it is for you.
Okay, so Denise just asked, she said, thank you. That's our pleasure, Denise. How do I access a recording of the second one, please? I'll send it to you, Denise.
Amanda, can I ask you a coding question around the stock rec?
Sure.
Okay, so let's say when we've got to send our heifers to the works, the empty heifers to the works, and at the start of the year they were R1s, but then they became R2s. Are they R2s when they go to the works as empty heifers in March?
Yeah, if they should have been in calf, then they would be classified as R2s.
Okay, cool. Thank you very much.
Kirsty just asked, how easy is it to change your accountant?
It is literally just getting in touch with whoever you want to talk to, and we'll have an initial discussion, no expectations. And if you decide to change, it's just a simple matter of we write to your old accountant and advise that you'd like to change over. We ask if there's any ethical reason that shouldn't happen, and then they transfer the files effectively.
Cool, thank you. And thank you for your feedback as well, Philip. Hey, if there are no more questions, guys, just want to extend my thanks again. I will remember. Thank you very much for your time and effort with the whole series that we've put on, Amanda. I know it's taken quite a bit of putting together from your guys' point of view. And yeah, just from our end, thanks very much to Phoebe for all her administration of this. So thank you very much. If there are any questions for Dairy NZ or for Bake Tilly going forward, then please get in touch and we'll endeavour to make sure that they are answered to as well as we possibly can. So,
awesome.
Thank you all for your time. I really enjoyed listening to that. It's something I really don't know a lot about, so I could listen to a couple more times, and I think each time I'd learn something new. So thank you all very much, and enjoy the rest of your day.
So thanks heaps, Mark. Thanks for Dairy NZ working with us on this series as well. Well, it's been brilliant.